name's Justin Belonge. I'm the CEO for the Aquaculture Council of Western Australia, and it's our pleasure to be able to bring you these webinar series. As I said, our apologies from Rachel Kelly, who normally leads this process, who is overseas at the moment. I'd like to start by acknowledging the First Nations country that I'm joining from, which is Minang Bibliman Noongar Budja. And I'd like to express my gratitude for the custodianship that First Nations people in the past have given for the lands that we all work, live and play on, and for the ongoing contribution that current and future First Nations people continue to make towards caring for our country. I recognise that a number of you are also joining from various First Nations places too, and I pay my respects to any First Nations people that are joining us today. Today, we'll hear from Matt Weaver, who's the Head of Climate Risk and Resilience at Howden Australia, on how aquaculture businesses can manage exposure to natural hazards and unlock investment in adaptation through insurance strategy that align with resilient strategies. When we did the Aquaculture for the Future planning, the industry needs analysis and the climate vulnerability assessments that we undertook identified business risk mitigation as a key need. And we know that industry is looking both to this adaptation space, but also the insurance space, including self-insurance as mechanisms for addressing their risks. So we thought, what better way to explore the topic than getting an insurance expert to talk to you, and to also see how the risks associated with aquaculture can be managed and accounted for. So thanks in advance, Matt, for your presentation that you're about to help us out with. Can I just do a few little bits of housekeeping before I hand over to Matt? We'll have questions and answers at the end of the webinar. If you have anything that comes up as a thought through the process of the webinar, if you like, you can put it in the chat, and we can ask the question at the end. Or if you want at the end, when we get to the Q&A, you're welcome to come off mute and raise your virtual hand and ask the question, old school style. During the webinar, if you can make sure you're muted, that's great. There's always some background noise that comes on, so if you haven't done that, please mute. If your bandwidth is slow, please think about flicking your camera off during the presentation. Sometimes that helps just with the loading of slides and things like that. And then lastly, this webinar is being recorded and it's being shared on Aqua's new webinar webpage. But with that, Matt, I'm going to hand over to you to start your presentation. Thank you very much.
Thank you very much, Justin, and good afternoon to all of you, and thank you very much for the opportunity. It's certainly not something that people generally run towards, a discussion on insurance and risk, so I really appreciate all your attendance, and hopefully I can keep you all enthralled in the topic of risk insurance and risk management for the next 40 minutes or so. And as Justin said, please feel free to drop any questions into the chat box or raise your hand towards the end, and I'm certainly happy to answer any curveball questions. I love those. So hopefully everyone can see my screen. Just by way of brief background, someone talking? Just by a brief background, because not many of you or not all of you would have heard of Howden. Howden are an international insurance broking firm and risk advisory firm. So we've been present in the Pacific now for about 5 years, since 2021, and we're now expanded our operations across Australia, New Zealand, and most recently, since February this year, into Fiji, which is super exciting for us as we start to bring a different bit of thinking into the way in which we support our clients to understand their risks and to effectively pass what risks they want to into the insurance market. And as Justin said, for those entities that are willing to self-insure, we can also guide and support on that particular process. The slide I'll leave for now because it'll be shared later in case anyone's really enthralled in reading bios and company profiles. But on to the magic. So today's discussion, I thought I would start with a little bit of an overview of climate change more broadly. As Justin mentioned, with climate vulnerability assessments occurring across the Australian landscape and various sectors, many of you would be well attuned with what climate is doing to your respective businesses. But I want to give just a little bit of a highlight as to how it's shaping the insurance markets and how insurers are starting to respond to these ever-evolving challenges from a climate perspective. So what better way to do it in terms of framing the discussion is just to talk about the broader global temperature increases and the impacts within the Pacific. So nothing revolutionary here other than the startling outcomes of global temperature increases over the last century. And this graph just shows the change or the difference in annual global average temperatures compared to the pre-industrial levels. And increasingly, we start to see the trend increase over the last couple of years, and more specifically as highlighted at the top of this beautiful graph, although not a nice looking graph in terms of its outcomes, but we're getting very, very close to the Paris Agreement range. And once I add 2025 in there, I think we start to tip over. Global perspective, then moving into the Pacific perspective, a similar picture and an increasing trend in temperatures across the Pacific region. And more startling is that 7 of the 10 warmest years in recorded history have occurred in the last 10 years. So for all the naysayers out there and our friend in the US who thinks it's all a farce, the temperatures and the science is certainly there. And I think one of my Westpac colleagues that I worked with, and he presented these topics, he said that climate change is as scientifically proven as gravity. So it's something that we all need to start working with and starting to help our businesses get more resilient to these impacts. And interestingly as well, a survey which is done about a year ago just spoke to most of the lead authors with the Intergovernmental Panel for Climate Change, who does most of the modeling and sort of collects all the research from around the world to develop all the climate models that most of the global economies are using to make their decisions. And startling that around 77% of the respondents to that survey suggested that temperatures will exceed the 2-degree Paris Agreement target by the end of the century. So we're starting to look at effectively staring down the barrel of a significant issue, again, on the assumption that nothing gets done. But it's not all doom and gloom. Economies are transitioning. Economies are moving towards clean energy sources and decarbonizing at an accelerating rate. I personally work a lot within the carbon markets in the Australian market and helping insurance to de-risk those projects. So a lot of investment is going into both clean energy and carbon abatement and carbon avoidance. So it's not all doom and gloom. Interestingly, and this is a graph I specifically selected given the nature of this discussion on aquaculture and the proximity to oceans and ocean temperatures, is just looking at the ENSO cycle, or the so-called cycle between El Nino and La Nina, which does have a material impact and correlation with severe weather phenomena, be that La Nina events, which typically result in, as we saw on the East Coast a couple of years ago with extreme flooding, which was what they referred to as that triple dip La Nina cycle. But we've also seen startling sort of rises on the other end of the spectrum with very, very strong El Nino conditions over the past. Now, I certainly preface this slide with that the IPCC and academic research does not provide conclusive evidence as to how global rising temperatures will have an impact on the cycle, but we're starting to see a bit of evidence emerge that these cycles are getting more frequent and more severe. So we're starting to see bigger swings from a very low La Nina event through to a very high El Nino event, and this certainly causes havoc from an Australian continent perspective. And in terms of the forecast over the next 12, 18, 24 months, a lot of scientists are suggesting that we're going to move into a very strong or a super El Nino position, which in the context of you on the west coast is probably less from on the east coast it's all bushfire, and on the west coast it's probably wetter conditions, which could affect your industries in some shape or form. Also draw attention, I won't spend too much time on the slides, just given the time that I have today, but Australia is certainly leading the pack from a global perspective with the introduction of the Australian Sustainability Reporting Standards, which I'll certainly touch on in the next slide. But recently, its first national climate risk assessment was conducted, which really had the purpose to start to provide a national evidence base on climate risks to people, economy, infrastructure, and ecosystems. And all of that should, and hopefully does, start to inform a national adaptation plan and guides actions at all levels of government, from federal through to state and into local government. Some of the key findings which I'd like to highlight with you today, if you haven't read the hundreds of pages report, this sort of synthesizes it into some of the more material topics, whilst not covering all of them, but there are some key ones that I'd like to highlight. Extreme heat, bushfires, floods, coastal inundation, those perils will intensify and compound. Sea level rise could reach 1 metre, which would double the number of Australians exposed to coastal hazards to 1.5 million by the year 2050 and 3 million by the year 2090, which of course will certainly impact where we live and where we work, given that all of us reside at least somewhere near the coastline, or the vast majority thereof. More relevant to government topics, but and people and safety, but the average number of heat wave days per year could double and quadruple. Heat-related deaths could rise 4 to 5 times in a 3-degree warming world. And ultimately, the most vulnerable groups, not only in terms of, let's say, the aged or the young, but also those in very remote areas of Australia, are most at risk from that perspective. Average spending on disaster recovery could increase by 7 times by 2090. This is important to you and into the topic of insurance, because the more that economies are impacted by these events, the more that there's a disaster recovery spend, the more that insurance is coming in to pay claims, and the more events that occur of that nature. So insurance companies are going to start increasing premiums in order to maintain their sort of level of profitability over time. And to be honest, I also like to draw attention that it's not just what's going to happen in Australia, because a lot of the insurance premium pressure that we saw the last couple of years with multiple increases impacting the Australian market was actually as a result of hurricane activity in the US. So the world from an insurance perspective is and always has been a global market, which means that events in foreign countries are likely to impact us here in Australia. And if this trend on disaster recovery continues to increase in Australia, it certainly increase elsewhere in the world, which places more pressure on businesses from an insurance spend perspective, which also highlights the need to take more of an active control of your risk management, and starting to look at ways in which you can mitigate risk to the maximum level, whilst passing the unwanted risk to the insurance markets where possible. Heat exposure, from a productivity perspective, can also is projected to cost, between, it's quite a wide range, but between 135 and 423 billion by 2063. Agriculture, construction, manufacturing, and I'm assuming aquaculture as well, will be losing many work days under a 3-degree world, simply because people can't be exposed to those temperatures for lengthy periods of time. And then it's listed last, but it should actually be right at the top, is ecosystem collapse, a loss of our carbon sinks, and then very relevant to the aquaculture industry is food and water security, because ultimately, without what you do, we can't eat, and we're in a pretty tough position to survive as a society. What does this mean in terms of implications? it's no different to how each of you would approach your business. It's around proactive adaptation and risk reduction, and a longer term view. It's not about what climate is today and what it's doing to your business today, which I'll touch on later in my slides, but it's about what will the situation look like in 10, 20, 30 years time, so that you can make decisions today that will increase your business's capability to be resilient to these changes. We're seeing a lot of businesses start to invest more money in resilience today because it's cheaper today, effectively. But we're also helping a lot of companies to understand what is the return on investment of investing in resilience. How does that impact your profit and loss account and your balance sheet, and how do you save on insurance premiums, and how we can help you to really have those meaningful discussions with the CFOs and those sort of parts of the business to help drive a good business outcome from a financial perspective. Then, as I said, and I spent a little bit of time on this, Australia leading the pack globally. You may all have heard of the so-called Task Force for Climate Financial Related Disclosures, TCFD. Australia implemented towards the beginning of last year a rolling 3 or 4 year cycle where businesses from the top end of town through to the small and medium-sized businesses need to start including sustainability reports as part of their annual financial reporting process along their auditor's report, their audited financials, and their director's sign-off. Now, I'm the first one to say that when I hear the word sustainability, it's a bit of an eye roll, because ultimately, as soon as that word is mentioned, everyone immediately starts to think about glossy reports, which show how great we're doing from a sustainability perspective. But what these standards are trying to bring is businesses on the journey of understanding what climate means to their business and how they can adequately respond to those challenges. So simplified, I know it's way more complicated than this, and some businesses are currently going through this process, and it's far more complicated than I'll suggest, but really boils down to 2 key topics. One is about what is the carbon footprint that your business has? So how many carbon emissions do you emit on an annual basis? And then what are the climate risks and opportunities to take advantage of from that perspective? And out of those 2, once you have identified them, it's about, well, A, if you've got a carbon footprint, how do you decarbonize, and how do you reduce your emissions within your supply chain and within your influence, and how do you influence other parts of the supply chain, either up or down, to reduce their emission footprints. But then what do you do in terms of investing into carbon projects if you still need to and you haven't been able to reduce your carbon footprint sufficiently? That's largely relevant for the large high emitters in this economy, but a lot of entities are going on a voluntary basis to purchase and invest in carbon projects to reduce their emission profiles. More relevant to today's discussion, however, is, so you know about your climate risk, you've got a quantification, which I'll step through in a second, around how certain perils impact your business. Now it's about setting strategies that can help you to de-risk that. And that's obviously centered around some form of risk management framework. And what I highlight here is that it's not just insurance. It's not just about sourcing either traditional products or some alternative products, which I'll also mention later today, but it's also about how can you invest in resilience itself. And then probably the topic that most people start to get concerned about, because it's not the most exciting topic in the world, but certainly the governance framework that sits around all of this. So, onto aquaculture, and sorry for the lengthy talk around climate and all the doom and gloom and all the reporting standards. But through the Howden Specialty Group, we have a specialist team out of London who deal with aquaculture insurance from a global perspective. I'm the first to admit that I am no expert in aquaculture insurance itself. However, I get to lend an ear effectively and get the intel that I need from our specialists. The topics that I'm far more close to is more in the parametric insurance space, which I'll certainly touch on a bit later. But first, I just wanted to touch on some of the topics that were raised as part of the brief for this webinar around the traditional indemnity insurance products. So the first one is what we call an all risk coverage. So it's mortality and or physical loss of your insured stock resulting from one proven sudden and unforeseen event. And as the name suggests, all risk coverage means everything's covered, certain to, of course, in the insurance world, certain exclusions, which I'll touch on in a second. Then you have the alternative to say, well, I don't need all risk coverage. I'm only really worried about specific risks. So you can effectively cherry pick or tailor your coverage to cover mortality or physical loss of insured stock resulting from sudden and unforeseen event that is caused by an insured peril or a named peril that you've selected. So some of the named perils as part of this named peril coverage are the usual suspects in your industry, like pollution, malicious acts, flood and flood-related suspended inorganic particles, storms, tropical cyclones, subsidence, landslip, water supply system failure, natural catastrophes like drought, fire, earthquake, tsunami, freezing and frost damage, and then some of the others as listed, mechanical electric failure, plankton bloom, which is also something super interesting to look at from an alternative risk perspective, which I'll touch on later, and then disease events from that perspective. And then, of course, no insurance policy would exist without exclusions. So things like intentional slaughter, unexplained or mysterious losses, including cannibalism and losses identified only at grading, pre-existing conditions known that would have been known prior to policy inception, medical treatment not carried out in accordance with manufacturer guidance, gross negligence, consequential loss, and legal liability. Lots of T's and C's, but that's the traditional indemnity insurance market. One question that was asked in preparation for today's discussion was, how are insurers approaching underwriting the impacts of climate? So within the aquaculture sector, and my specialist in London gave me this intel, that climate risk is certainly an evolving underwriting consideration with the major aquaculture insurers assessed at both site-specific and global levels. So what that means is ultimately insurers are taking far more notice of the impacts of climate change on the behavior of these perils than previously, because effectively the models that they were using in the past are now not suitable to model today's risk. These models need to be updated, and the consideration for the impacts of global temperature increase need to be allowed for. There's certainly more focus on the increasing frequency and severity of events. I mean, it was pretty incredible to see, while it's not necessarily climate change driven, but certainly Cyclone Narelle and its track from Cape York Peninsula through the Northern Territory all the way around and then down the coast of Western Australia is certainly one of the longest track cyclones that I've seen in my years of working in this space. We're starting to see greater engagement with brokers, surveyors, and insureds to understand exposures and risk mitigation measures. So the old world of here's your insurance policy and we think your business looks like this is starting to disappear, and we're starting to see insurers take more account and allow for insured entities like yourselves and your risk mitigation features and what you do, which in some respects for those who have more advanced risk mitigation in place, you're now starting to reap the rewards of that those processes. And of course, naturally, catastrophe pricing plays a huge and a larger role within the aquaculture sector, with higher deductibles used to manage loss volatility in high loss or high risk locations. From a global aquaculture market perspective, recent months we've seen some sizable losses in the aquaculture sector. That's more of a global perspective rather than Australia specific. We are seeing insurance capacity increase materially, with 4 global insurers now writing aquaculture risks, and I'll mention those insurers in a later slide. Our aquaculture specialists feel that market capacity is now at its highest level in the last 15 years, and insurers are actively seeking new business and are open to new opportunities, which could present exciting opportunities for each of you to approach these markets through your broker and start to see what solutions may not have existed in the past that now exist from that perspective. Mitigation strategies. I was also asked to just get some intel around what farms are doing from an aquaculture perspective to reduce the effects of some of these risks and to secure better terms. Ultimately, in terms of mechanical electrical breakdown, a lot of players are having backup generators and oxygenation systems with increasing standard and alarms linked to staff phones to enable rapid 24-hour response. And some farms also require staff to live within 15 minutes of a location, which effectively just helps to mitigate the effect of any mechanical electric breakdown and try and limit the impacts thereof. In terms of plankton bloom, sorry, I should have mentioned, these are onshore perils, typically more sophisticated water quality sensors and closer monitoring of the key parameters, and automatic phone alerts triggered when thresholds are exceeded, allowing a very rapid response. Some of the offshore perils and the mitigation strategies, again, from a storm and natural catastrophe perspective, it makes sense that stronger, more reliable cage materials and moorings, more frequent inspection and maintenance, and then the use of the underwater drones and divers, as well as aerial drones to assess structural integrity on a regular basis. In terms of plankton bloom, similar to what we saw on the other side for the onshore perils, it's all about early detection. So using satellite data to detect blooms earlier, bubble curtains and submersible pens used to lower stock by several meters, and increased monitoring as we saw for the onshore perils. In terms of disease, we're starting to see higher uptake in vaccinations, increased wellboat bathing, and farms more selective in their source of their juveniles. And while it's listed there, freezing and supercooling and ice damage, well, we're not going to have icebergs rolling up into the northern parts of Western Australia. We talk more about blowers used to maintain water movement and prevent freezing, and some farms relocating stock during peak winter conditions. So that's what I've touched on so far is, let's say, particularly in the indemnity insurance worlds. For those who haven't heard of parametric insurance, I'll touch on that briefly and give an overview of how that works. But ultimately, before I touch on parametric, the concept of indemnity insurance, as the name suggests, is about indemnifying the insured for an event that occurred, subject to terms and conditions of the policy, like deductibles, limits, all those sort of things. In that indemnification process, it strongly requires loss adjusters and claims assessors to go and determine the extent of the loss. Whereas in parametric insurance, we flip the equation and start to look at what parameters would be met and what that would cause in terms of financial loss to your business, and we just pay out based on those impacted parameters. So what is parametric insurance? Parametric insurance provides cover for losses linked to a predefined event measured against objective data. The structure is typically most effective when there's a high correlation between the defined event and the financial loss. And I'll start to give examples in a sec, if you bear with me, to put rubber to the road. And payouts are triggered by agreed indices or parameters, hence the name, that are transparent, independently verifiable, and available to all parties, both the insured, the broker, and the insurer. So how does it work? Well, I always describe as when something happens and the time between an event and you finally getting your payout from an insurance policy, which includes the loss adjuster process and the umming and ahhing and the argy-bargy with insurers, we take that process and we move it right up front. So instead of looking at a cyclone event coming through and damaging your infrastructure and getting claims assessors to assess it, we can design a parametric insurance product that pays out based on the wind or the wind speed or the track of that cyclone and the resulting storm surge that impact your particular location. So if you know, for example, and I'm not referring specifically to aquaculture here, but I had a fly-in, fly-out facility in Western Australia where they knew that their infrastructure could withstand 300 kilometer per hour wind speed. So we designed an insurance product that started to pay at about $250, just to allow for the fact that there's flying debris and that would cause some damage. And they knew that when it hit 300 kilometers an hour, the roof would fly off and it would cost them $5 million to repair that. So we set up a defined trigger, which is the wind speed. When that wind occurs and it breaches that 300 kilometer threshold, they get paid their $5 million. So there's no loss adjusters, there's no umming and ahhing, there's no delayed process, and typically these policies will pay out within days rather than potentially months or even years in some extreme cases. One thing that I do recommend, and something that we are seeing more and more, particularly with these climate-related perils, is that parametric insurance does not replace indemnity insurance. It can be used to complement existing cover. So while your traditional indemnity policy might give you everything you need for the various perils that you're concerned about, but for instance, a certain peril is sublimited or there's a big deductible, we can structure parametric products that can sit and fill that gap, because ultimately we just need to be able to have some data source that we can work off, which I'll touch on in a second as well. And we structure and design these products and work very closely with our clients to do so. So what can we cover? I mean, if you can measure it, we can cover it. So wind speed or named storm, the wave height, we can certainly do from a parametric perspective. Water temperature, phytoplankton density or chlorophyll A concentration is certainly something we can do. Water salinity levels, all these different measurable events are certainly more effectively. You can build a history of how that data has behaved over the last 10, 15 years. Then effectively the insurers will use that to build an insurance product, which responds at the different levels. So appreciate it's not aquaculture, but in the context of on-land farming, I work with a lot of farmers in Western Australia and across the South Australia with lack of rainfall covers, and we combine those with high temperature covers. So for a defined period of their season, if it's dry and hot, the product starts to respond and effectively protects them against, in their world, a mass mortality or a lack of yield, but certainly something interesting in aquaculture space that we can look at around the plankton blooms and measurement of those. Now, the first question everyone will ask is where's these data sources and how do we have enough history to develop these products? Typically, insurers over the last couple of years have become more willing to use remote sense data, so things like satellite imagery and satellite measured data sets, which does mean that we have a history. So for many cases, I always say the sky's the limit, and my colleagues laugh at me, but ultimately, if it's measurable, we can insure it. So I just want to step through. I'm just conscious of time. I might speak for another 5-10 minutes, and then we can jump into Q&A. So I want to just talk about de-risking solutions for an aquaculture farm. And what I build up in this graph is fairly simplistic, if you bear with me, but I'm going to list some of the risks that would exist across an aquaculture facility. And that on the left-hand side of the graph at the moment is very clearly before risk mitigation. And for a lot of entities that are sophisticated and have risk management frameworks in place, that bar or that stack will decrease, because there are certain perils that you can have risk management frameworks in place and certain controls and procedures, or things like I mentioned in some of the mitigation section that reduces the size of that risk. But ultimately, and this graph is certainly not to scale, there will be residual risk that your risk mitigation cannot handle to the full extent. And that's really where insurance starts to play its role. So this first box that I've illustrated is an example where certain perils like certain perils we can cover with parametric insurance because they're measurable, things like plankton bloom, water temp, and any natural peril. Whereas in those parametric insurers I've listed to the right there, Descartes, Berkshire, Liberty, Swiss Re, Munich, and AXA Climate. But then more specifically to some of the earlier slides around indemnity, which is more on the sort of all risks cover, subject to exclusions, we have the aquaculture insurance. And those are the players like AXA, the Global Aquaculture Insurance Consortium, which is made up of Munich Re, Axis, MS Amlin, and Tokyo Marine, got Convex and Sunderland Marine. So it just gives you a sense that there are options, and some clients are very strong, and they feel that their risk management frameworks for a particular peril are stronger than what the insurer gives them credit for, and they're willing to wear or self-insure that particular risk, which might just leave a few other risks that they're not so comfortable with, and then we can explore either parametric or indemnity solutions to cover those. I realize I've spoken now for 40 minutes or so, maybe another 5, and then, as I said, I'll be happy to open up to questions. So what I wanted to stress as well, with the onset of the Australian Sustainability Reporting Standards, as I mentioned before, it's all about quantifying climate risk. We're not in the world anymore of high, medium, and low, and moderately severe, very severe. We need to start getting to dollars and cents, because that's ultimately what's going to impact the financial resilience of a business. I'll step through the slide very quickly, but the starting point is identification. So what risks is your business is exposed to, which is typically related to the geographical location of your business. Quantification then becomes where insurance plays its critical role, because that's what insurance companies have done for hundreds of years, is quantify what a physical risk means in terms of a dollar or a cent. So that's where the insurance expertise can come in. And then we've got all the usual suspects from a risk perspective. We've got the acute risks, which are cyclones, river floods, coastal floods, bushfires, etc. And then the more long-term changes in risk, like precipitation changes, sea level rise, and temperature changes. I'll skip through transition risk just in the interest of time, because I want to show you a little more on the cash flow approach. There's also a little bit on opportunities where it's not all doom and gloom. There are opportunities to take advantage of, particularly with today's retail customer, more aware of green and greener approaches to food security. So there are ways in which that you can develop your product better or greener, cleaner, and result in competitive opportunities from that perspective. Then we complete the cycle. We obviously manage the risk, we strategically plan, we implement, and as any cycle suggests, while that's still a linear sort of curving road, we need to constantly evaluate, because the science and the evaluation of these perils will change over time. Now, all of these things will result in a financial impact, be it on revenue, expenses, assets and or liabilities, or your ability to raise capital or finance. And what I underpin here, and the conclusion of the slide, is that insurance is there to help reduce the magnitude and or volatility of that financial impact. So now I'd like to just very briefly go through a quantification of financial impact and what it means to potentially your business. So let's keep it simple. Let's look at revenue as a cash flow of interest for a farm. And I'm no expert in aquaculture, so you can all throw your arms up and say, I don't know what I'm talking about, but I just put in a few examples just to illustrate the discussion. But assuming biomass growth rates and harvest timing are key drivers of revenue, climate-driven variability may include things like rising water and air temperatures, which influence growth rates, feed conversion and mortality, tropical cyclone activity, which disrupts farms, hatcheries, logistics and harvest schedules, sea level rise and coastal change impacting site viability, infrastructure, and long-term asset value. Biosecurity events, disease outbreak, pandemics affecting stock labor and or markets. And of course, climate risk can always impact your costs, including the invariable insurance number, and not in terms of availability, but its price. Supply chain disruptions, as we're seeing, it's not a climate-driven issue at the moment with the war in Iran, but certainly businesses are feeling the pinch from a supply chain perspective, and input cost pressures around feed and energy. So great, that's lovely, list them. Now what? So what we do ultimately is we start to work with our clients and our partners to start to model this. So what I've just shown on this graph is effectively a year of operation and the various potential cash flows that would have happened in that particular year. So as you can see on the graph, there's some very small, faint blue dots around the $80 mark for revenue. Those are the years that were potentially impacted by, a bad season, a reduced harvest schedule, all those sort of things. But they only happen, maybe once out of 40,000 potential scenario years. But the important part is that's modeled under today's climate. Fast forward 5 years, and this is all fictitious, but bear with me, that the shape of that might change, because in current climate, your profit was, or your revenue was pretty centered around 95 to 105. Now you're seeing a more of a tail down, and you can see some revenue numbers even down to 60, which could be a pandemic event or a huge tropical cyclone that came through. But the point is that the cash flow probability and frequency is changing. And ultimately, the point that starts to help in terms of longer term planning is what does your business today look like in 30 years time climate? And how does that impact your decisions today in terms of how you can, what plans and actions can you put in place right now that can help limit the effects of these? And this is just, as I say, fictitious example or hypothetical example, just to illustrate how we're going from climate into cash flow, and then cash flow is where decisions can start to be made and to support you on the journey, which is not only investing in resilience, as I mentioned, but also finding insurance products to pass some of that tail risk away into the markets where it kind of belongs. So I think I'm basically on time. Very, very happy to take any questions. I see there's some questions in the chat, which I'm happy to address, or anyone raise their hands. These slides will go out afterwards for anyone that wants to get in touch, and happy to field any questions.
Thanks, Matt. That's that's fantastic. Sobering, but really good to see some insights into how insurers go about some of those calculations. Yeah, as you said, there was a question in the chat from Elizabeth Reed wanting to know about if you have any insights into aquaculture businesses that were covered by the algal blooms in South Australia and whether they had insurance premiums in place for that. Are you aware of anything to that extent?
I have to be honest, I don't know myself, but I can find out and I can get an answer to that question. I think from my knowledge that there weren't many farms in that region that had insurance in the first place. So the easy answer to that is no, but I can find out for you.
That's great. Excellent. I have a few questions, but just a reminder, if you have a question, either come off mute, raise your virtual hand and ask it old style, or if you wish to tap it out and put it into the chat, I can ask it on your behalf. So, but in the meantime, I was just wondering, one of the findings from the climate risk analysis that CSIRO and IMAS has undertaken has shown that the risk of heat stroke for farm workers with businesses working in the north is going to increase significantly. You've spoken a lot about infrastructure insurance. What do you foresee happening in the future in terms of workers' compensation insurance premiums and the like?
Yeah, I mean, there's one of many different paths that it can take. My gut feel is that workers' compensation insurance and regulations will get stricter in the sense that there'll be certain conditions that workers won't be allowed to go and work in, which ultimately still is a business risk because you lose work days in many respects. So that's where you'll see the insurance shifting from a workers' comp perspective, probably more into the parametric insurance world, where effectively, and I've done this for a mine in Queensland, where on average they lose 10 days of production because of the temperatures, but that's getting more volatile. So 1 year they could lose 30 days, and that delta or that 20-day difference, that's where they're looking for insurance cover to step in and provide that effectively loss in revenue as a result of those lost work days.
Yeah, okay. And just that comparison of parametric versus liability insurance, how do the premiums compare for a similar level of payout? How do the premiums compare for the two different approaches?
Very good question. I mean, ultimately, parametric insurance, like traditional indemnity insurance, is as expensive as likely the outcome is going to be. So draw a parallel to a farmer on land again, sorry, but someone who wants cover for what he asked me for recently is when rainfall falls below a certain level. And I said to him, that's fine, but that happens every 2 years. So you're looking at a 50% premium at least, because that's as likely as the event is to occur. Typically, and I can't speak on behalf of all of the insurers, all these insurers that we work with have the indemnity side as well as the parametric side. They're both using the same set of models underneath. So the premium that you would pay under an indemnity policy for a cyclone is technically used with the same model as we do for a parametric side. So the model is the same, but what can change the premium to be more attractive is that you as the client have full flexibility to structure your parametric product. So as I said, that FIFO organization, they knew that their building would withstand 300-kilometer wind speed. They don't want a traditional indemnity policy because they felt that the insurer was assuming too much about their property. And when insurers make assumptions, they inadvertently fill that with premium. So they said, that's fine. Give us our fire and burglary and all that type of insurance, but we'll do parametric cyclone alone because we want to own and control that risk. So the short answer is they're slightly different, but it gives you more flexibility. And we typically work with our clients to understand, A, what's the risk and what does event of magnitude X mean to your business, and let's structure a product that way. We get back a premium of, let's say, 10%, for example, and then we fine tune it because obviously budgets are budgets.
That's good. I'll come to you in a moment, Alison, but Justin asked a question in the chat about, is there a requirement for, you can see this as well, Matt, I'm sure, but for others who might be able to see it, is there a requirement for aquaculture operators to undertake rigorous surveillance? Justin's thinking of reporting on increased nutrient levels as a predictor of potential harmful algal blooms, chlorophyll A, etc., where are good indicators about what's going to happen, well, about when it's happening, but as a precautionary measure. So what obligation falls back onto the operators to do that surveillance and provide that data?
Yeah, and again, that's on the indemnity side. My guess would be that insurers would certainly value that, but ultimately, you buy an insurance policy that covers you for an algal bloom, and if you have good surveillance in place, you're limiting the exposure, because no one really wants to claim on an insurance policy because it means something bad has happened to your business, and that just causes financial impact regardless of the outcome. Certainly in the parametric space, greater surveillance on the client side, similar to the example I had with the FIFO entity, is if you've got good surveillance in place and you can do something about it, then you structure your parametric policy to only really cover you for a sudden and unforeseeable event. So for I don't know the first thing about algal blooms, I must be honest, but if something was to materialize really, really fast and you weren't able to detect it and get the stock out of the water and move it, that's when you want the insurance policy to cover you.
Very good. Okay. Alison, please ask your question if you want to come off mute. Oh, you are. Go.
I think it's a little bit of overlap on the last question, but it's about the data gathering itself. So what onerous expectations are there on the, I guess, yeah, like the insurer versus the operator themselves? Because obviously, how would the insurer necessarily trust the data that's being provided, for one? And then secondly, a lot of these data sets, in particular for ocean scenarios, it just aren't there, like, unless they're recorded by the operators themselves. So I just wondered if you've seen that and how that's managed.
Yeah, certainly. I mean, the first preference of the insurers is for an independent data set, which is not always possible, given the nature of certain, as you've described, instances. They typically, I mean, again, talking somewhat of a parallel, but the insurers tried a couple of years ago to do the rainfall cover for farmers and giving them rain sensors, but they quickly found that the farmers were putting umbrellas on top of the rain sensors and getting payouts on the insurance products, which is clearly a moral hazard topic. So the starting base is always independent, his preference, but in some cases that's not possible, and it takes the insurer a bit of a journey to trust that while it might be your data set, that there's inability to tamper, inability to manipulate, and I mean, I would assume it's it's not as easy to manipulate, some of these sensors determining, water salinity and all these different things versus a farmer putting an umbrella on top of a rain sensor. It's not an easy journey, don't get me wrong, but it's certainly something that's I like the uphill battles, because I work a lot with insurers about getting them comfortable with the data sets that we're using.
It's an interesting component though, isn't it, Matt? Because like, I guess for mum and dad insurers, for smaller farms, smaller aquaculture enterprises, you're more likely to get some sort of generic package. If you're a large operator, I'm sure one of your people would come out on site and look at all of the different adaptations and changes and data and other bits and pieces. Obviously, is it right? There's a threshold here where it makes sense for you guys to look at something versus just run it off the model, right?
Absolutely. But there are a lot of, particularly and again, it's a parallel industry, but there are a lot of carbon players who on their own are not big enough to really to make these premiums make sense, and the risk manage or the risk benefit that the insurance policy provides. But we look at an organization in let's say a homogeneous sector such as yourselves, and there is the option to start to create like industry-wide self-insurance vehicles where you basically bandy together, and then suddenly your risk profile is far different. The premium pool is much larger, and you can benefit from the same type of buying power that a large organization would. And that goes more down the path of the self-insurance type route. But it's certainly something that's, again, if there's enough vested interest between the parties, there's no reason why they can't get together and insure specific regions, specific sectors, all that sort of stuff.
Yeah, okay. Very good. Is there any other questions from people in the chat either want to come off mute and ask themselves? Okay. Yeah, Matt, I think the self-insurance space and the area around bringing like-minded companies together to look at that is an interesting space. We are aware of some companies within the aquaculture sector that are self-insuring now because the premiums are just far too excessive for their cash flow and their business operating. So I think if that's an area of interest from people who are members of Aqua that want us to explore, then we're happy to bring people together for a conversation around that. Does your company and others, do they provide consulting advice around self-insurance approaches, Matt?
Absolutely. So we've got a dedicated arm called Alternative Risk Management Solutions, and that's everything that they do. And we found a really nice niche, even though Mr. Chalmers has changed all the tax rules on discretionary trusts as of last night. We typically use discretionary trust as the vehicle to do the self-insurance, largely because it's super cheap to set up and it can act and behave very much like an insurance company. And it then means that entity can get insurance above itself. So we have a dedicated team who can certainly facilitate and be part of those discussions.
Great. Well, thanks, Matt, and thanks again for your presentation today. We really appreciate it. I think everyone's more or less stuck on, so I'm sure they've been very engaged in what you've had to provide. Matt has graciously offered to share his slides with us, so we'll make them available through our website. You can see that there are links in the chat if you want to access various parts of the Aquaculture for the Future website. They are there that you can go and grab various bits of information from, and also the links to the webinar. Even though for anyone who came on late that may have wanted to see the earlier stages of it, the video of this will be up probably within the next couple of weeks or so. So keep your eyes on that. Couple of points before we all jump off. We're always open to suggestions on future webinars. So if you have anything that you would like us to look at, please drop it in the chat now or reach out by email. Really happy to get people like Matt along as industry experts to come and talk to you about points of interest or focus for you and your businesses. And just before we jump off at the end of the half hour, just a few updates. I just wanted to recognise Kyle Hodson is our recently appointed Policy and project officer is on the call today. So Kyle, for those that may not have met you, I'm sure there's not many, but if you'd like just to come off camera or come onto camera and off mute to say hello, that would be fantastic. I didn't tell you can do that, but if you can, that would be super if you're still here.
Yeah, hey everyone, glad to be here. And yeah, if you ever want to reach out and touch base, I'm always here on the phone. I can share my contact details in the chat maybe.
Yeah, great. Thanks, Kyle. Appreciate that. And a few other bits and pieces, just immediate things that we're working on at the moment. We are negotiating the amendments to the Fisheries Resources Management Act. We've DPIR'd at the moment. We're trying hard to get as many things changed within the Act that allow for greater resource security for you as aquaculture licence and leaseholders, including longer terms, greater transferability, and some other concessions that we think would make things more more practically functional for you as individual aquaculture businesses. So keep your eye. We'll keep notifications flowing on that work through newsletters primarily. Kyle is leading some work on some aquaculture spatial planning analysis to help identify areas of prospectivity for aquaculture to allow us to have more focused input into policy settings around marine parks, but other areas in Western Australia. So over the next 6 months, Kyle's going to be working really hard doing a multi-criteria spatial analysis piece of work on that. So if you're interested in that at all, please reach out. Again, we'll have updates in our newsletters, but we're more than happy to take calls from people around that. And lastly, we're doing some planning around a multi-day oyster workshop to provide information for new aspirants and existing operators in the edible rock oyster sector with information on growing oysters. So we'll provide more information on that as it comes to hand. It's going to be later this calendar year, probably somewhere in the August-September period. So if you have an interest in that, again, please reach out. But that's all of my little bits of promo at the end of the webinar. Again, thank you very much for staying online and listening to everything that's been presented today. We'll have our next webinar roughly in a quarter. So yeah, if there's anything you'd like us to focus on, please reach out and let us know. Otherwise, have a great rest of the day. Thanks, everyone. Cheerio.
Thank you. Bye.